Welcome back to the 980s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 980 Capital Group. Thank you guys for joining us. As I always say, subscribe to this channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions, or you go to the website at www.9icapitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, and engage. And today we're talking about the best interest contract, the DOL. This is going to be a series of conversations because I just don't get it. I really don't give a damn. At the end of the day, I want you to understand as the consumer why this is important and who it impacts. Today, we're talking about why the insurance lobby doesn't care about your best interest. Let's get it. So we're here to talk about the insurance industry, why they lobbied against your best interest, and why you should be concerned on the direction it goes. So this weekend, I received this notification from a client. It stated that the insurance lobbyists blocked the federal crackdown on costly retirement advice. This is not the first time they've gone against the best interest standard or the fiduciary standard, but the insurance lobby has been cracking down against this for quite some time, since 2016, ever since the Obama administration put this into play, where they're talking about best interest standards, fiduciary practice, and everybody should be under one simple rule of the fiduciary standard. Now, why is this an issue? Why is this a big deal? Well, the question remains, does the insurance industry have your best interest at heart? Does the insurance industry have your best interest at heart? So let's back this up a little bit and talk about regulation best interest. This rule is established by the SEC that requires broker-dealers to act in the best interest of their retail customers when making recommendations on any securities transaction or investment strategy involving securities. It became effective on June 30th of 2020. Regulation BI aims to enhance the standard of conduct for broker-dealers beyond the existing suitability standard, focusing on transparency, conflicts of interest, and the broker's responsibility to prioritize the client's best interest. So this was designed to standardize what's going on in our industry, where all financial advisors should be operating under one standard. The insurance industry, however, is at odds with this. And so are broker-dealers. A lot of them are going to say, oh, it's going to increase our cost. Oh, it's going to increase our liability. Oh, it's going to increase the cost for the consumer. Maybe in the near term, but of course, as we know, the law of economics works over a long period of time, all of that prices should come down. So here are some key components of Reg BI. One, disclosure obligation. Broker-dealers must disclose material facts about the scope and the term of their relationship with the customer, including fees, conflicts of interest, and the capacity in which the broker is acting. Two, care of obligation. Brokers must exercise reasonable diligence, care, and skill when making recommendations, ensuring the recommendations in the best interest of the customer based on their investment profile. How hard is that? How hard is that? Three, conflict of interest obligation. Broker-dealers must maintain or establish and enforce written policies and procedures reasonably designed to address conflicts of interest, including those arising from financial incentives, aka commissions. And lastly, compliance obligations. Firms must create and maintain and enforce policies and procedures to achieve compliance with Reg BI. That doesn't sound too bad, right? Doesn't sound too bad at all. But why is the insurance agencies and the broker dealers so upset? So, insurance lobby has expressed opposition to Reg BI primarily due to the concern about the potential impact on insurance products that are treated as securities. For example, variable annuities and certain life insurance policies. Here are some reasons why the insurance lobby is blocking or pushing back against regulation best interests. One, increased regulatory burden. The insurance industry argues that Reg BI imposes additional compliance costs and regulatory burdens, particularly on smaller firms that may struggle to adapt to the new requirements. Okay, that makes sense. Smaller firms being hurt, pushed out of the industry, which ultimately could lead to higher costs for the consumer. Maybe. I don't know. Two, potential reduction in sales. Let's just start there. Reg BI could lead to reduced sales of certain insurance products, particularly those with higher commissions, because brokers may avoid recommending these products if they believe doing so would not be in their client's best interest under the new standard. Obviously. That just makes sense to me. Three. Now, this is where I kind of go on the side of them. There's an overlap between what's the state regulations. The insurance industry is also concerned about the potential conflicts of overlap with state insurance regulations, which already impose certain standards of conduct on insurance companies and agents of broker-dealers. They argued that Reg BI could create confusion and inconsistency across different regulatory frameworks. Yes, I wholeheartedly agree with that. But here's the catch. The impact on commission-based models. This is where the rubber meets the road. Many insurance products are sold through commission-based models, which are scrutinized under Reg BI. The industry fears that brokers might shift away from these models, reducing the availability of certain products to consumers and impacting brokers' compensation structures. I disagree with that. Why do I disagree with that? It's because it's just going to force those insurance products to reevaluate their solutions. Those solutions that they're currently, we'll get to that. We'll get to that. I will get on my soapbox here in a second. Lastly, the lack of clarity. The insurance industry contends that Reg BI's requirements are not sufficiently clear, particularly concerning how the best interest standards should be applied to complex insurance products. This uncertainty could lead to legal challenges or conservative practices that limit product offerings. So, the lobby is concerned with regulation BI, how it could disrupt the industry, how it could disrupt sales practices, and how it can limit the availability of products and services across the industry, which, you know, it's an argument. It's definitely an argument. My concern, like I said, if we're talking about the impact on compensation structures, that will change anyways. Let's talk about the investment business, how that's changed, how everything has been a race to the bottom. ETFs, mutual funds, the expense ratios, all these different things has been a race to the bottom. It's already happened in one industry. The same thing is going to happen to the other industry in regards to the changing of the product lineup, the changing on how that product is offered. It may not be offered through a commission now it may be offered through only a fee-only model. It's okay. Things change. One thing I'll say is this has to be standardized. You can't have people calling themselves financial advisors or financial planners or financial consultants or financial gurus in this business without liability. So let's talk about the fiduciary standard versus the best interest suitability standard. I always talk about one point. The main difference The main difference is the fiduciary standard has significant liability on the products and solutions that they sell to you or they provide for you. If they provide you a product or solution and you're not happy with them, you can go after that individual because you feel like they didn't do what was in your best interest. From a suitability perspective, you can do the exact same thing. But guess what? As long as you check that box, as long as you did this, did that, and it was suitable at the time of the investment, there's nothing you're going to get. You can go attack their E&O, you can do all these other things, but at the end of the day, there's not much restitution there. So the moral of the story is that the people that are fighting in our industry, whether you're being a fee only or you're being a commission-based advisor, is that one side of the business feels like they're operating on the fiduciary standard while the other side of the business is operating on the suitability standard with very little recourse. And the people on the insurance business side are going to say, we have recourse, we have to have our E&O and all that stuff. I get all of that. Yes, you do. But at the end of the day, the fee-only model, the fee-based model, the fee side of the business has a significantly higher recourse and or liability, which in turn puts them on the same side of the fence in regards to the business model. Now you're going to say, oh, business model. What business model are you referring to? You just charging AUM, or you're charging them a fee just to have a conversation with you, or an hourly fee to have a conversation with them. Yes, all the above. For what I do for my clients, for what we do for our clients is an ongoing service. My client will call me on a Saturday with an issue. I'm answering the phone. I'm answering the call. I'm having that conversation because it matters. Their kids going to school, or how about this? I had a client where their kid's school shut down, and she's having to go to a different school. Guess what? I was there. I'm there for them. Let's put this money over here. Let's do that. Let's send the money out. I'm doing that. We're doing these things. It's not a one-off solution where they buy an IUL or something like that and their kid does that. What are you doing? Nothing. You've already spoken to him. You sold the product. You're not having the conversation again. It doesn't matter anymore. There's no more compensation you're going to get unless you're going to get the renewals on the insurance. Those are one-off sales. What we do is a lifetime engagement. And that's how we differ. This is going to be a multiple series. I'm going to have multiple people coming on. I'm going to have people from the insurance industry coming on here and having conversations around this topic because it's important. I just had to get this out today because, well, it's new on your brain. Thank you guys for listening to the 9 podcast. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. Go to the website at www.9icapitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, and engage. And today we talked about why it's important, why the insurance companies don't want the fiduciary standard, why they're balking at all of the things and they're blocking all of these different things. These insurance brokers, these insurance lobbyists don't want this to happen. Are they not working in your best interest? Hey, I'm not going to put that on them, but I'll tell you this. We are. And that's what we do. Stay humble, stay safe, my friends. I'll see you again soon.